I went and looked at a market that I do not invest in, I don't have that same level of knowledge. I don't have that experience, that expertise. But in the markets where I buy real estate and we operate, I know down to the property level, the neighborhood, what's happening. And so it's very easy to be able to identify, well, this is an opportunity if I can buy it at this price, and it's not an opportunity at that price. And so you really have to either align yourself with the people who have that knowledge and invest with them and trust in their judgment, or you yourself have to develop that expertise and experience to be able to get the advantage and be in a much better place as an investor. Welcome back to the Investor Mindset Podcast. I'm your host, Steven Pesavento. And today in the studio, we've got Peter Goldstein. How you doing today, Peter?
Hey, Steven, just great. Great to be here, and thanks for having me.
Yeah, I'm super excited to talk to you because you're a longtime entrepreneur. You started when you were really young. You've had exits along the way. Your current business is focused on helping middle market companies IPO and reach those capital markets. So I'm sure we'll get into some of that. But where I'm really interested to start with is a guy like you who's had a lot of success, who's been an entrepreneur. If you start by looking back, what events or influences from your childhood shaped who you are today?
Yeah, that feels like it's going back a long ways and a lot of experiences. Successes, failures, hardships all along the way helped me shape, myself as a businessman I am today. I think I was that classic entrepreneurial mindset as a kid. I grew up in the suburbs of New York, so we had the four seasons. So, I was mowing lawns in the spring and summer and raking leaves in the fall and shoveling snow and the paper route. So it was really, from early on, my family was not entrepreneurial per se. It just seemed to be in my DNA and my framework and something I loved to hustle. And of course, I love the output, and the rewards from being able to make money. So I always knew I would end up in business for myself. I didn't know exactly what that would be, Steven. So it was really been, at 61 now, quite a journey for which there are many milestones and highlights along the way. I can, happy to dip into any one of those with you. I think the most meaningful kind of line of demarcation came in my 20s, at 24 when I started my first company in New York City. But leading up to that was kind of that desire, that internal kind of drive to want to be in some form of business of my own.
I mean, was it a stable home? Was it money was easy and consistent? Or was it something where you felt like, oh, entrepreneurship is going to get me out of this, or entrepreneurship's going to get me another level of freedom? Or what was it that really attracted you to it when you were young?
It's interesting. So I would say middle class, probably lower middle class, and working family. My mother is a Holocaust survivor. And so I think that there is distilled in me a certain mindset of being able to really not just, thrive, but to overcome hardship and to continually grow and do better. And so while she demonstrated for me work ethic and the value of a dollar, our family, I would say, really wasn't instilling, going down an entrepreneurial pathway for any of the kids. And we're all professionals. We've all done really well. It was really more what I saw was the opportunity to grow and excel and to learn and to apply myself to do something different. And one of the beauties of being an entrepreneur now over 35 some odd years is the ability to have a goal, to work towards it, to be able to achieve that. And money isn't the only marker of success. I think there was more from a young age, and still is, a desire to learn, a desire to grow, and a desire to produce results.
Yeah, I think it's so important to understand where we come from so we can understand how we got there, because I think a lot of people start from different places. They have different motivations. They've got a different purpose of what they're trying to solve for. But in the end, that path can be inspiring to see, what you've been able to do, because, at 24, you start a business. Tell me a little bit about what that was like, because, at 23, 24, I've also started businesses and bootstrapped it and all of the pains and tribulations that go with that. But there's so much that also comes from it. So tell us a little bit about that.
Yeah, I think, maybe it would be interesting to share some of our experiences. At 23 and 24, you're still developing, right? Your brain is still in final stages of
Yeah.
formative, and we think we know a lot at that stage. Certainly overconfidence and ego and drive play a lot into that decision making around that age. And I had started a career in the restaurant industry prior to going out on my own. And I was working for a very prominent restaurant in New York City called the Rainbow Room, and I had reached probably one of the highest levels I could at that age of being director of operations in one of the New York's finest properties. What was clear was that wasn't what I wanted to do.
When I was a kid, I wanted to be a chef, and then I realized, wow, that is a tough career,
Yes. Yeah, and what's that old saying? If you can't stand the heat, get out of the kitchen. Well,
Yeah.
it was clearly. It seems like it wasn't for you, and it wasn't for me. But that springboarded me into the first business that I started, knowing that there was an opportunity and a demand for the product. So I ended up going into a food-related distribution company in New York City. And on my 24th birthday, I actually went to City Hall on Center Street, 60 Center Street, and got my first business license. And the commonality 35 some odd years later in all the business I've been involved in and what I look for is a product market fit. So is there a demand for the product? And at that point, there was a company that had just recently gone out of business and no one yet had stepped in to fulfill the need that was there. And so at 24, you don't realize the risks that are inherent in leaving a paycheck and starting and going out on your own. No money, no real formal business plan, right? It was all bootstrap. And it was based upon the mindset of, okay, I'll put together one account at a time, one client at a time, one step at a time, and fill and build what I knew was, one of the strongest markets in the world for the restaurant industry. And took that, every day, week by week, and really built something meaningful to the point where I had my first exit at 30 years old.
Yeah, I have to imagine it felt good to have that exit, but I also imagine that, you build something from 24, you find this product market fit, you see what others don't see, and you go after a business that you have a connection to, but you don't really know what you're doing when you get into it, but you learn so much along the way. I have to imagine that it was both exciting to sell the business, but also that there was some other feelings. Kind of tell me what that was like, having that big victory in the exit, but also, letting go of what you built.
Yeah, it was a strong exercise in the giving up attachment to an outcome, and I equate it to having my first kid. I'm a father now. I have 2 adult children. But that was kind of like my first baby. And I remember when I had sold it and there was an earnout component and a meaningful performance based, and the people that took it over didn't run the business the way that I had, with a very high touch, high service. I worked, it was perishable industry. So, it was a very demanding sector. And so they didn't perform as well. And thereby my performance and my payout didn't go as well. So the exit was not as meaningful from a financial perspective. So I learned a lot from that vantage point. More importantly was realizing that you can't control everything that happens, especially when you do a merger and acquisition, or you're combining cultures, you're combining different business opportunities. And so there was a lot of emotional component. There was a lot of financial component. And then there's the stage of, okay, I just spent 6 years of my life, countless hours per week, sleepless nights, building, growing step by step, brick by brick. And my identity is no longer attached to that. I was a fun period. That was when celebrity chefs were coming on. I was servicing all the better and finer restaurants. So I was single. I was living in New York City. It was a very fun period and fun stage of life. And then all of a sudden, that's no longer there. And then comes the moments of, who do I now, an opportunity with a clean slate to recreate, redesign, and look at the next steps of the journey as an entrepreneur.
Yeah, and how'd you approach that transition? Because I feel like what I've seen in my personal experiences, I've built businesses, I've exited businesses, I've built it again, I've transitioned, I've pivoted, and things are working along the way, but they keep growing. And there's a point in time where, your identity gets so caught up in what it is that you do and what it is that your business does, and that becomes who you are. And so as you're transitioning out of that, what was it that you clung to find your way to that next opportunity?
Yeah, I love that question, Steven. And actually, I took 3 or 4 months. It's kind of the helicopter approach, right? Just lift up a little bit, look out from the balcony or look out from 10,000-foot view, and really examine, where do I want to go? What's my purpose? What served me and what didn't serve me, before I jumped into kind of what's next. And I think that's a really valuable exercise, whether you've made a transition or even in your current business to, like you mentioned earlier, quarterly, you take time to go travel. I think it's really important to take time and to really take perspective on where you are, especially in this world. Things are moving faster, right? Data, information, technology, AI, we're overloaded. So the decision-making processes are really, if you look at it, driven by past experience. A lot of times that's trauma, right? Or things that have gone wrong, and maybe then we gravitate to wanting to do something differently. I say the common link for me has, from that point on, has been a purpose working within a community, and that's the entrepreneurial community, where I feel like I can add value. And the reason that I focused on the small to mid-size, kind of cap companies and that entrepreneurial culture is that I feel I can make more of an impact. I relate to entrepreneurs. I am one, it's in my DNA, right? It's in my 24/7 blood. And I love that. And then I love having the ability to see what I do be impactful, which is why I didn't want to go down a corporate route or go down towards larger enterprises. Not that we couldn't make an impact there, but it takes a longer period of time. It's like the idea of turning the cruise ship, right? I can make and turn, a small craft much quicker, be much more adapt and nimble, and make that impact working with the entrepreneurs. So that's been a common thread from that point, which I was 30 to now, 61. So the past 31 years has been really more designed around how can I work with and add value to different stages of emerging growth entrepreneurial companies.
Yeah, I think that's like a really exciting place to be, because as an entrepreneur yourself, you understand, the trials of being a founder, the trials of running a business, undercapitalized, understaffed, people bootstrapping, people trying to figure out how they can get to that place, that end goal that they want to, or at least enjoy the path that they're growing on, and having that wisdom and experience is super important. And so, today you're running a very different business than you started. And I know along the path you kind of grew into that. But today you're supporting businesses that are looking to get capitalized. And in today's market, investing and capitalizing businesses in 2024 is very different than it was just a few years ago. And it will be very different than it is a few years from now. And so what are some of the key takeaways that you're seeing in the market today that are influencing the decisions you make, both as an investor, but the decisions that you're recommending those operators and those CEOs that you work with make when it comes to capitalizing their business? Because I think those two, people always look at them from one or the other, but when we bring them together, it's a really powerful lens to be able to understand.
I agree. It's the combination of both. And as you said, I work in the capital markets. 2021, Steven, was the most robust IPO market we'd seen in 20 some odd years. Roll the tape forward, 22, 23, now in 24, it's one of the worst IPO markets we've seen in over 30 years. So that cycle was pretty significant, right? Like the cliff just basically dropped off of the IPO market. And so now I actually found my business to be much more challenging in a rewarding way, because when money is moving and the markets are robust, it's much easier for companies to attract capital. And so just the shift in the last few years has gone back to where my focus always is on the fundamentals. Can you demonstrate product market fit? Can you demonstrate that you have made sound assumptions to be able to grow your business, scale your business, right? Execute on your plan and provide a return to the investors and the stakeholders of the company? And that is more and more evident in today's market. There's more capital on the sidelines now, Steven, than we've probably ever seen in our lives, in our careers, even our lives combined. And so what are they looking for? They're looking for the ability to demonstrate return on capital, fundamentals, growth. And that doesn't mean that you have to be profitable now. What I see is the confidence to be able to demonstrate accurately with a track record, right, of performance, clear assumptions, definable, and that executable plan. So whether you're early stage, mid stage, which is where I focus on, latter stage, to me, look at the next 2 years, look at where you've come from in the last 12, 18, 24 months, and make sure that you can support and to be able to communicate and demonstrate to the investment community and to the stakeholders, right? So it's not just the capital, your employees, your customers, your board, your advisors, all the way through, that each aspect of that can demonstrate value. And if the value is there, it doesn't have to be always financial value, right? There's intangibles as well as intangibles, quantifiable and quantifiable. All of those things come into play today, more so than I think they ever have.
Yeah. So it's super important that you can share that vision, that you can show where you're going and what you're doing when it comes to capitalizing the business. And what I'm also hearing is that when you're looking to invest in a business, you're looking for those things. You're looking to understand, why is now the time? Why are you the person to be driving that ship towards taking advantage of that opportunity? And why should I join you on that journey as an investor?
Well said. Well said. I also work a little bit backwards. I look for the deficiencies and the holes and see how they're going to be plugged. Because no business is perfect, right? And especially in the small to mid, emerging markets. And just like we're working when we list a company, we're looking 18, 24 months out, and we determine what all the criteria that we need to meet will be in the future. And we work back to today. And identifying those deficiencies, I think, can be really valuable, whether you're looking to an exit, whether you're looking to attract capital, or whether you're just looking to scale, which is to be really authentic about where are your weaknesses. And then what are you doing to identify those and have a solution? You don't need to have it all in place today, but you want to have the ability to identify, look at those solutions, and have a diverse and robust set of advisors and stakeholders that can help you in realizing the gap between where you are now and where you want to grow into as an entrepreneur.
So as an investor, if I have, let's say I have a pile of money, I'm looking to take advantage of things in the market, what's the opportunity of getting involved today versus, say, waiting 6 months, waiting a year, waiting 2 years, waiting 3 years? Obviously, we don't know what the future holds. We're not looking to make a guarantee prediction, but we have to kind of intuit where things are going to go in order to make smart decisions today. And obviously, you're specifically focused investing personally and then helping other people, get capitalized in the public markets. So what's your take on that? How should people be thinking about that if they are looking to be a public market investor?
Well, you used a really key word, which is intuit, right? And I think that investor sentiment right now is probably a blend. Picking companies in the stock market is not a perfect science. That much has been really clear over time, right? The success rate of just kind of, luck versus actual, data supported, investing in the stock market has turned out to be very, very blurry at best. So, then informed intuition is where I like to look. And that is, if you have a sense of a business that you understand, that you like, that you have an affinity towards, that you can resonate with management, their mission, their purpose, their track record, where they're going with the business, and support that with the data. And the data could come in a number of different ways, depending on what the key metrics are of the business and what it is that, your investment horizon is in that particular, situation. Are you looking for yield? Are you looking for a dividend? Are you looking for growth and equity? So I don't think there's any one answer that would satisfy, my perspective as an investor or even your audience. I think it's very specific. And then I could go into the blend of, your investment approach, right? So you've got, high risk, low risk, mid risk and low risk, and some blend around all those. I tend to go towards higher risk, higher return investments, but I do them in a way that they're securitized. the best that they can be. So I'm getting higher risk and higher return, but that's my risk profile. So risk profile comes into play here very significantly. I don't really believe per se in market timing. I do believe right now that there are more opportunities as a contrarian to invest and bring your money to market. With all the monies on the sidelines, you have access now to unique business opportunities that I think are undervalued and are looking for capital, which is difficult to bring out of the sidelines right now, meaning that there's potentially higher returns to those investors who are early movers while the rest of the money is sitting and waiting for kind of that herd mentality, right? Once things open up in the markets, there's going to be a rush. And if you look at the difference of valuations, just take tech, where it was in 2021, the peak of the market, same companies now are valued 20, 30, even 40% lower. Great opportunities if you know where to look and you're willing to be, kind of risk oriented in putting your money to work.
Yeah, I couldn't agree more. I think that there is a unique opportunity, but in order to take advantage of it, you have to be very clear on what is your risk profile, what is your objective, what's the goal, and how do you mitigate that risk, and how do you mitigate it through having strong understanding, having strong advisors, mentors, people like yourself, having the experience in the market. Now, personally, I'm not a public market investor, so despite understanding quite a bit about it, I have no expertise in that space. All of my expertise is as a private investor, either in private equity and primarily in private real estate. And so even in that space, just as a comparison, I'd love to hear one from yours in the public market. But in the real estate sector, what we've noticed is that the institutions are sitting on a ton of cash and capital. So anything that fits their buying criteria is getting bid way up outside of the mark of where we would typically buy. Therefore, the risk is too high for the reward and the amount of work that needs to go into it. And so we shifted down market, and we were able to find deals like we were buying 3, 4, 5 years ago with deep discounts, lots of upside, lower risk, but it balances nicely because we're looking where everyone else isn't looking. And so what have you seen as a comparison in the public markets or in kind of the sectors that you focus on?
Very similar, Steven. It's that kind of contrarian, looking where others aren't and willing to deploy capital. If you look at the IPO market, the majority of the companies, over the last 2 years have been underperforming, their issue price. So, we're seeing the opportunity to buy in the open market very, very attractive. And what's getting done are kind of the jumbo, the unicorns, and the very much the lower kind of micro cap, segments. And in the last quarter, there were more IPOs done than the 2 years prior combined, with positive yield. About a 12%, 13% performance, and life science sector being excluded from that, and technology is driving a lot of that. But I think the answer lies a lot also in the market knowledge and what I would call market intelligence. I don't know enough about your sector to want to feel comfortable, and probably vice versa. So you want to align yourself with people that have current market intelligence and do your homework. If you just look at the basic fundamentals of really understanding what you're investing in, why you're investing in, and what the risk factors are, and getting that market intelligence applied, you have a much higher chance of a probability of a better return than just going into an investment without really having done all that market, research.
Yeah, it's like once you have that insider knowledge and you have the ability to understand in depth that specific niche, it really does give you an advantage. It makes you feel so much more comfortable. I know for me personally, if I went and looked at a market that I do not invest in, I don't have that same level of knowledge. I don't have that experience, that expertise. But in the markets where I buy real estate and we operate, I know down to the property level, the neighborhood, what's happening. And so it's very easy to be able to identify, well, this is an opportunity if I can buy it at this price, and it's not an opportunity at that price. And so you really have to either align yourself with the people who have that knowledge and invest with them and trust in their judgment, or you yourself have to develop that expertise and experience to be able to get the advantage and be in a much better place as an investor.
Agreed.
So when it comes to this idea of going public. I think it's a really interesting topic, and I'd love to finish up kind of talking a little bit about this and maybe one or two other items. But my understanding has always been that, there's less and less public companies than there ever has been in the past, that there's a good reason for that. The regulations make it difficult to go public. It takes a lot of administrative effort, and that you really can't go public unless you're at a certain size. And, in the real estate sector, that's $1 billion worth of real estate under management or more. And in the outside of real estate, I know, it's a significant size. So talk to me about what enables this shift or opportunity for smaller, mid-sized companies to take advantage of the public markets. What's the upside and what's the downside of going that direction?
Yeah, I love the question. I mean, this has kind of been my area of focus and of study. I wrote a book called The Entrepreneur's IPO just for this really purpose, that there's a myth on Wall Street, and you just mentioned it. It's really that you have to be a unicorn in order to go public and access, the capital markets. And that came about, Steven, with the dot-com bust. When dot-com was at its peak and all these small and early stage kind of high risk companies were going public at excessive valuations, well, that market crashed, right? The balloon popped. And thereby came this sentiment around Wall Street that if it's too small, it's too high risk, you shouldn't go public. And, I can just tell you that that's just not true. 25 years later now, there always has been a micro cap and a small cap market. And so it's accessing capital as an alternative to venture capital, private equity. This would be institutional and or specialized institutional financing, family offices, kind of, a unique aspect of capital that's driven towards liquidity. So those investors, their mandate is to be able to invest into companies that have current liquidity. And that separates them from a lot of other pools of capital. So that is always going to be an opportunity for companies to seek capital. And that is really, when you're an early or mid-stage company, that's transformational capital. These are small, I would say, so to give you an idea, microcap is $50 million valuation to $300 million. Small cap, $300 million, $2 billion. And that's a wide berth of companies. And those companies are able to access capital, which is the upside. The downside is it's expensive and it's volatile. And now you're in a business, in addition to your operating business, you have to run and operate all the requirements of meeting and satisfying being a public company: transparency, reporting, governance, shareholders. So there is a significant challenge. And then, of course, you're stuck with the market price of your stock, good and or bad, which puts additional pressures on. So it's not an easy road. I've done it myself twice. I advise many, many companies. Some have worked better than others. In all transparency, it is not for everybody. There are significant benefits to having that liquidity and access ongoing capital, on attracting employees, for mergers and acquisitions. I could go down a long list of benefits and challenges just as well. So if you choose to go down that road, make sure you have the right team of advisors who are knowledgeable and can work with you through those pluses and cons, and kind of pros and cons, I should say, plus and minuses of being public at an early stage versus building with private and venture capital. And there's a long list there of kind of risk and reward on why you'd want to choose that option.
What's obviously every situation is different. Every size of company is different, but what's a ballpark of what it costs a company to go public, and then what it costs them to administer and live up to what's required being a public company?
So the answer is also depending on the complexity of the business, right? And there are ranges that I can give you. I've been involved with and comprised. I'm a big believer in keeping costs down, especially in the beginning for a smaller and emerging growth company. We've done it for as little as $250,000 to $300,000, and spent probably as much as $1 million. Under the scope of taking a company through all the stages of audit, legal, preparation, filing, governance. There's a lot to it. with a good team who has knowledge and is willing to work also for the longer term, you can compress a lot of those costs. And it's the same thing then once you're public. I like to put about $1 million budget, could be more, could be $2 million a year. So it really is depending upon size, stage, and complexity of the business. And then of course, the ability to manage those, budgetary items, ongoingly and leading into the IPO.
Is the cost of capital cheaper by going to the public markets in the long run, or is it cheaper by going to private?
It's a great question. And it really depends on the performance of the company and how they do in the open market. Cost of capital in the beginning is going to be very similar. If the stock accretes well and does well in the open market, then you have access to significantly more capital, institutional capital, both in debt, and in equity. The expensive part in the way of dilution to current and existing shareholders then come if the stock doesn't perform well and you're doing more equity financing, then of course you're diluting, the current shareholders. So there's no, perfect answer to it. It is the way I'd like to position it for you and for the listeners is that it's an alternative. And it's a viable alternative for those that want the liquidity and the access to capital at the right stage for their own particular and unique characteristics.
Yeah, I think it's a fascinating world because it's one that I obviously don't play in, but it's one that you see as kind of that pinnacle moment of success when a company IPOs and it goes public. But from my perspective, that's when all the work starts. Like there's a great example of a friend and a mentor of mine. He ran one of the largest real estate funds in the world, and they went public after operating for 30 years. And he, at that point, that was when he retired because he said, I don't want the headache of working for and participating in a public company. And they had obviously had a crazy amount of success in the private markets, but by going public, they created massive amounts of liquidity and a huge jump in the valuation of the company and the portfolio because of going public. It was almost like a 3x or 4x multiple by having now access to that public market.
Yeah, it's a trade-off, Steven, right? And it is, that's why you want to build a management team that has experience and knowledge and or recruit the right people to be on your team to help manage that other kind of new business that you're in of being public and the requirements of that. And it's also very hard for certain founders when they're used to running and making decisions under an entrepreneurial structure, when they now have a board and they have governance. And so there's pros and cons to looking at it. That jump in valuation and that liquidity and access to capital are the three that I'm going to focus on always. And, if you look at what tech companies have done, even recently, they're giving out stock and stock options to attract and reward human talent. This is a time in our world where it's really critical to be able to attract and retain the right people, and giving them stock and options with liquidity is one of the key factors, for attracting and maintaining quality human capital on your team.
So let's shift gears here. When you invest personally, obviously you've built businesses, you run a company. It sounds like you have a lot of experience in the public markets, in the entrepreneurial sector. Talk to me about what you invest in personally. Are you investing primarily in the public markets? Are you taking positions in private equity? And are you taking positions as an advisor and earning kind of that investment return? Have you invested in real estate? Kind of talk to me a little bit about how you've built your portfolio and where you've focused on for you.
So much as we were talking earlier, I had hedged my portfolio approach. I split it into real estate, residential, and this was before the Great Recession and then the financial crisis, and the other half was in the capital markets. And I put all my personal money into those two different buckets to diversify, and it was all residential, jumbo real estate in South Florida. So if you think of ground zero during that period of time, so I lost everything there. It was the toughest period of my life, where never in my lifetime did I think that I would have both events occur at the same time. So I had a very simple hedging strategy, and that did not work. So I'm here to tell you that I've rebuilt myself. And losing everything from a financial perspective was one of the best teachers I've had in my life, about my own personal position, about humility, about what's important, about my personal values, about my family values, about my values around money. And so I've obviously, during the process of rebuilding, gone to some real estate, but I'm much more heavily weighted now in what I've built as a very specialized investment thesis. And I even put together a boutique investment fund around this that focuses on pre-IPO, IPO, and existing public companies. And my investment thesis is around a debt, convertible debt or convertible yield structure, where I get a return on my capital, 20, 25% returns, with equity kickers, both in the way of common stock and warrants. So I've identified a market opportunity that comes out of the knowledge that I have to provide capital for high growth private and public companies with a very specific kind of investment thesis around bridge investing. So that could be bridge to an IPO, it could be bridge to an M&A, some form of a special event or a special situation where we can identify a gap in capital that's very hard for companies to access, meaning they're not going to go to private equity, they're not going to go to venture, they're not going to go to an investment bank. And so that's kind of the space that I've identified. Last year, I had about 40% gross returns for myself and the other investors, about 29% returns. So it's a niche, and that niche is inside of the knowledge of an investment strategy that we're doing with select companies and kind of select criteria that's very disciplined and I would say very narrow in its approach.
Yeah, what I think I want to underline about that is really you have a special set of skills, knowledge, experience, and what you've done is set up a vehicle where you can apply that knowledge for yourself, but also bring along other people to help juice the overall returns and access a much more diverse, wider pool. It's kind of like the same reason we accept private capital is because we could buy 10 properties ourselves, or we could buy 100 properties together. And ironically, 100 properties together, well managed, is much more diversified and therefore creates a lower risk profile.
Agreed. And then, with that diversification, you get a basket, right? For you, it's a basket of properties. For us, it's a basket of companies. I spoke with one of my investors this morning and who's going to, participate further for just that reason. So, we can vet, de-risk, and diversify the portfolio approach in this sector, which, is very unique. It comes from, many years of experience and also having the ecosystem around me. So we have opportunities to work with investment bankers, with securities attorneys, with the exchanges, right? With the entire ecosystem for which we've been a member of for 20, 25 years. So inside of that, kind of the old saying of in niches, there are riches. Well, if you look at all of the large, even the Magnificent Seven, right? They all started off as small companies somewhere in their journey. And that's where, I love to work and then to deploy capital. But it fits inside of being able to identify kind of that niche, which is very, very unique, very small in the overall scope of the investment thesis of Wall Street. And as an example, there were after the kind of things fell down in 2021, there was about a 60% decrease in the number of companies, as you were saying, that went public during that period. And there was probably about an 80% decrease in capital, right? So then where's the money coming from? And that's when I launched the fund in 2022, because I was getting opportunities coming to me and there really wasn't a good product market fit. It's not a good fit for hedge funds. It's really not a great fit for family offices. And then who is filling that need? And it goes back to how I've seen most every company that I've been involved in, including my own, as an investor and as an operator, really excel and scale is when you have a niche inside of the market that can start small, that doesn't have a lot of competition because of that. And then you can produce the returns, the growth, and then begin to scale from there.
Yeah. There's so many juicy nuggets in here, Peter. It's really great having you on. Why don't you share with the audience where they can get a copy of your book or follow you if they want to learn more?
So feel free to DM me on LinkedIn. You can get the book on Amazon.com. But for your listeners, Steven, I'm going to give a digital copy for free. So you can just DM me or you can look me up on MSCAP. That's MSCAP.com. entrepreneurialmindset.com, which is the fund. You can email me there, and I'm happy to give more information, a copy of the book, and anybody else that I can add value to along their journey in growing their entrepreneurial business and entering the capital markets and or investing in the capital markets. It'd be my pleasure to do so.
So interesting. There's so much value in here. The idea of understanding what's in it for the operator, the CEO, when they take your money, what to look for as an investor, and so much more. Thanks for joining us, Peter, and thanks for listening to this episode.
Thanks for having me. I hope it added value to all the listeners.
Thanks for listening to the Investor Mindset Podcast. Make sure to hit that subscribe button. And if you'd like to watch another, here's one up top. And here's another great video right down below.